So, hello everyone. Today is the revision session for our last topic, which is topic 5. And topic 5 is about cost analysis for management decision. In this topic, we're going to learn about whenever a company is going to make a decision related to the different thing. So, which factors company or management need to think in order to make the right decision and appropriate decision. So in this topic, we're going to cover around 7 learning outcomes. In those 7 learning outcomes, learning outcome 2 is not part of your syllabus. So I give quick glance on each and every learning outcomes, and then we will go more in detail. So the first learning outcome is about profit estimation using 2 different approaches, which is marginal costing and the absorption cost. So if company using the marginal costing, how does company estimate the profit? Vice versa, if company is applying absorption costing, which is mainly used for the external users, or whenever company prepare financial statement, then company applies the absorption costing. And second learning outcome that we're not going to study, so I'm not going to talk about learning outcome 2. So learning outcome 3 is about the segment profitability. So whenever a company going to estimate the profit or the profitabilities of particular segment, which factors company keep in mind, which kind of cost company ignore, company avoid, and which kinds of cost company does not avoid, that we can be controlled. Okay. So learning outcome 3. Now move on to that's all about learning outcome 3, which is segment profitability. Learning outcome 4 is about the cost volume profit analysis. And with cost volume profit analysis, we're going to talk about the break-even units, break-even dollars, and of course, we're going to represent break-even using the graph. So graphical representation of break-even units and the dollar. Then we move on to the learning outcome 5. So learning outcome 5 is about the margin of safety. How does company estimate the margin of safety? What does it mean, and why company has to estimate margin of safety? Learning outcome 6 is about tax estimation or tax computation, or the impact on tax over break-even computations. So how does we deal or we exclude the tax from our net profit after tax in order to estimate the target profit before tax? So that is your learning outcome 6. And the last learning outcome is decision making. Right? So whenever a company going to make a decision, what factors company need to keep in mind? So in this learning outcome 7, we're going to talk about only 2 2 decision making. The first one is a one-time special order. Some company should accept one-time special order. A company should not accept one-time. And second one is insourcing versus outsourcing. We also call it accept or reject, right? Buy or bid decision. So now we start with the learning outcome 1. Right. So learning outcome 1 is about, as I said, there is about tax computation using 2 different methods, right? 2 different methods that company going to apply to estimate the profit. So here we have methods included 2. The first one is absorption costing. You know that absorption costing is very common method that most of companies they apply in order to estimate the profit. And this method we also use it to prepare our income statement, right? And the second one is the marginal costing. Absorption costing and marginal costing, right? So absorption costing. As I said that this method is quite common and you're quite familiar with this method. In our second lecture, we study about this this topic. All right. So I quickly give you ideas about absorption cost. So here is a sales minus cost of goods sold is the gross profit, right? Minus operating cost is net profit, right? So here the idea is manufacturing cost will be used to estimate product profitability. In this cost of goods sold, we have a fixed cost, fixed manufacturing, and variable manufacturing. Right? Fixed and variable manufacturing. In this operating cost, we of course have a fixed non-manufacturing and variable non-manufacturing. Alright? So, how to estimate cost of goods sold? You know that. We have opening finished goods, opening inventory of finished goods or opening stock, alright? Plus produced during the year, production during the year, right? Minus closing stock of finished goods. So that is your cost of goods sold. Keep in mind, we have to remove closing stock when we are estimating cost of goods sold. Why? Because as per the matching concept that you study in your financial accounting, that cost should be matched with its revenues. Right? Something that we haven't solid cannot be used to estimate the profit of the company. Alright, so closing stock still inside the company, that is our inventory, closing inventory, current assets, part of the balance sheet, still it's appear in the financial statement of the company. So we cannot use it to estimate the profit of the company. So we have to eliminate it. Alright, so we have to get it out from our cost of goods sold calculations. Right? So then we got gross profit. Gross profit is product profitability. Product is profitable to produce. So after gross profit, we have operating cost, non-manufacturing costs such as marketing, advertising, selling, transportation, distribution, and so on. Right? So then we have a net profit. So this structure is basically absorption costing, and I hope you remember that same structure or format we use it to estimate or prepare the income statement according to accounting standard, no matter it's international accounting standard or no matter it's a GAAP. Right? So second method is a marginal costing. Marginal costing is quite different. Second name of marginal costing, we also call it variable costing system. It means only variable cost will be used to estimate the product profitability. Why? Because variable cost is that cost, the company can control it. Fixed cost is that cost, company cannot be controlled, or which cannot be controlled by the company. Alright? So that's why if fixed cost cannot be controlled by the company, we should not use it to estimate the profit of the product. Alright? So we're gonna remove the fixed cost. Alright? So some people argue that the fixed cost is that cost that does not directly contribute to maximize the production, maximize the output, or maximize the revenues, or any kind of fixed cost, because which is indirectly related to the product. Alright? Now, so how to estimate the profit using marginal costing? So we have a sales minus variable manufacturing cost, such as direct material, direct labor, and direct expense related to the production, minus variable non-manufacturing cost. Alright? Variable non-manufacturing cost is marketing and advertising. Then we got contribution margin. Contribution margin, Alright, so only variable costs contribute in order to estimate the product profitability. Then minus fixed manufacturing cost minus fixed non-manufacturing cost. So here we got it, net profit. Alright. So the idea is this is a total variable cost. Alright. And this is total fixed cost. Alright. So sales minus total variable cost is contribution margin. So keep in your mind, sales minus variable cost is contribution margin. Is contribution margin minus fixed cost is the profit. Alright, so same thing is going on here too. Alright, so here is the fixed cost. We will give which after subtracting the fixed cost from contribution margin, we're gonna get it net profit of the company. So here you can see the difference between marginal costing and the absorption costing. Alright. So some companies apply marginal costing to estimate the profit, and some companies apply absorption costing to estimate the profit. But keep in your mind, when company prepares financial statement, company does not apply marginal costing to prepare or to calculate its profit, which we're gonna explain to the external users, or with that we're gonna include it in our financial statement. We never ever use marginal costing. We always apply absorption costing to estimate the profit of the company. Alright, to prepare the financial statement. So here, so the thing is that marginal costing for decision making purpose in terms